Hello, I'm Jim Lebenthal, the Chief Market Strategist at Sarity Partners and a member of our investment office, and this is our outlook on the economy and financial markets for the month of February 2026. With 1 month in the year already past, it's probable that the tone for the financial markets and the economy has been set. And that tone looks a little bit like this. There are a lot of things to be happy about and some things to be concerned about. What are we happy about? We're happy about a pretty powerful combination of forces that we think are going to keep the economy growing above trend and the financial markets growing with it. What are those forces? They include stimulus from the budget bill that was passed in the summer of 2025. It includes deregulation. It includes profit growth, low unemployment, and lowering inflation. But above all else, it includes economic growth here in the United States that is well above trend. The third quarter of 2025 saw real GDP after inflation above 4%. The fourth quarter, which has yet to be reported, is likely to be above 5%. Those numbers are well above trend growth for a mature economy like ours, which is projected to grow when at trend at 2%. And the stimulus from the budget bill may add to the momentum with which the economy has entered 2026. When you put that together, that economic growth should inure to the benefit of the financial markets. And indeed, we're seeing that in good returns, not just from the equity markets, but also from fixed income markets, where benchmark treasury yields are stable and credit spreads are rather tight. All of this is indicative and a response to the strong economic growth that I mentioned. But I've also mentioned that there is likely to be volatility ahead, and we've seen a lot of it in the first month. A lot of the volatility generates from policies and actions that are coming out of Washington, D.C. A lot of them are highlighted in geopolitics, and as far as the financial markets go, we are seeing that in a decline in the U.S. dollar. Partly, this may be some foreign countries worrying that the U.S. is not the stable ally that it has been for years and selling dollar-denominated assets because of it. It may also be because of President Trump's recent comments showing no concern over a declining dollar, thereby taking out of the equation that the Federal Reserve or the Treasury might intervene to prop up the dollar. So that's something that we're keeping an eye on, the dollar and volatility overall. But for all of those reasons that I mentioned, we do see positive forces ahead for the economy and the financial markets overall. As I close, I want to address one concern in particular that clients have brought up, which is whether the stock market is expensive or not. At 22 times this year's earnings, it certainly is not cheap. However, when we see earnings growth this year over last year projected at 15%, and then projected again to grow 15% in 2027, that growth rate means that the 22 times multiple might not be that expensive. And just doing a little bit of higher math here, we could get to the end of this year, and if the multiple were still 22 times, then that earnings growth of 15% alone would translate into a 15% price increase in the S&P 500. What may be more likely is that the multiple backs off 1 or 2 turns, and that we still get that 15% earnings per share growth, which if you put those two together means that the S&P 500 may increase by about 10% in the full year 2026. Time will tell, and we'll be here to update you month by month as the year unfolds. We're looking forward to it. Thank you for listening.